Everybody knows the feeling of walking into a supermarket, buying a product worth 20 kwacha, coming back 1 month later to buy the same product and now finding it trading at 23 kwacha. So that right there is what you call inflation. I'm Nathan, welcome to the FinLab, and in today's video I'd like to discuss the impact of a rising inflation rate on the value of your money. And let's try and outsmart inflation today. So firstly, what is inflation? So inflation in terms of purchasing power is simply the decrease in the value of your money over time, right? Now let's assume that the inflation rate is at 13% per annum and you decide to maintain a constant balance of 10,000 kwacha in your bank account for a period of 1 year. So after 1 year, your account balance will still show 10,000 kwacha as the bank balance, but the true value of your 10,000 kwacha will now be 8,000 kwacha 700 after adjusting for inflation. So this basically means that in real terms, your 10,000 kwacha can no longer afford you the same standard of living as it would have 1 year ago. So inflation will erode the value of your money faster than a mouse can eat cheese, right? But fortunately, there are several strategies to protect your money from the effects of a rising inflation rate. And in this video, I will only address two. So the first way in which you can outsmart a rising inflation rate is by exploiting short-term investment periods. So you see, as inflation rises, returns such as interest rates on fixed deposits, yields on government bonds and treasury bills tends to increase as well, right? So by investing in short-term periods, your investments mature more quickly, allowing you to reinvest your funds in newly adjusted interest rates. So this keeps your returns in line with the current inflation rate. For example, if you have 10,000 kwacha to invest for a period of 5 years, but you expect inflation to persist, consider investing in a 2-year government bond instead of a 5-year bond. So when the bond matures, you can reinvest it for another 2 years at the new inflation adjusted interest rates, right? Ensuring that your returns stay aligned with inflation. So the second way in which you can beat a rising inflation rate is by exploiting real estate investment trusts or real estate mutual funds. So real estate investments are one of the best ways to preserve the value of your money, as real estate typically tends to quickly adjust to inflation. Real estate investment trusts, or as they're referred to as REITs, allow you to invest in real estate without needing to buy property directly, right? So by purchasing shares of a REIT, you can simply sit back and watch your money maintain its value. So these trusts are available in the Zambian market. So real estate investment trusts are companies that own or finance income-producing real estate across various property sectors. So they pull money from different investors to invest in a portfolio of income-generating real estate. So by investing in REITs, you can potentially benefit from real estate income without the hassle of buying or managing property directly. So there you have it, a few ways to stay ahead of the curve. There are many strategies and ways for hedging against inflation, which we'll cover in future videos. Otherwise, thanks for watching. Don't forget to like, follow, subscribe, and share to help this information reach those that need it. Thanks and goodbye.